Good morning. This is your weekly update for July 11th, 2022. I am Jim Stewart. I'm the Chief Investment Officer at Worth Asset Management. And I was out last week. I was in Las Vegas with my team, coaching them, picking up one of these additional trophies. But let's go ahead and talk about how we're coaching on the investment side. Let's go over the three threes for the week. We're going to go over our three top market movers, our three favorite and least favorite asset classes, and how we're positioned, whether we're in protect mode, add mode, or growth mode. And I got a treat for you this week because we're going to go over how to win in a bear market. So let's begin.
Okay, great. Let's go over the top three market movers for the week. First one is jobs. Last Friday, the U.S. added 372,000 jobs in June, keeping the unemployment rate at a historic low of 3.6%. This increases the likelihood that the Federal Reserve will issue another 75 basis point rate hike. First time they've done that since 1980. Now, let's talk about earnings. Second topic here. This week, starting in July 11th, is the unofficial kickoff of the second quarter reporting period. And the investors are a little bit anxious because the economy is slowing, but how are earnings going to be reported? And more importantly, how is the guidance for the second half of this year going to affect stock prices? Very important, and that starts this week. CPI. On probably the most important number that's coming out this week will be reported on Wednesday. Coming off 8.6 last month, the consensus right now is 8.8 for June. I think it'll come in a little bit lower, which the market might like in the beginning. Then I think it will turn around and not necessarily like it. And then the PPI is reported on Thursday. Okay, let's go over the top three asset classes for July 11th. The US dollar, T-bills, and commodities are still in the top three, so no change for the past couple weeks. The bottom three, slight change. We still have long treasury bonds and the NASDAQ in the bottom three. We eliminated small cap equities and added global equities, which is a new addition to the bottom three asset classes. And here's the data to support that. Now, the week was kind of mixed, but if you zoom out on the 3-month and the year to date, you can see all of the area of weakness is down at the bottom three, while the area of strength continues to be in these top three asset classes. So again, we want to seek this strength up here and avoid this weakness down here. Okay, so how we're positioned in our three modes here. Well, nothing has changed over the past couple of weeks. We are still in protect mode and have been in protect mode since April 14th. But we do kind of like this bottoming type of process here. But again, we still need to see some more movement on the upside before we start to possibly add equities back into our portfolio. But more importantly, how do you win in a bear market? Jim, I'm going to just hold on because the market always bounces back. Well, yes, on a long-term basis, yes, it does. But after we go through some major corrections like we did through the great financial crisis in 2008 and 9, it took 6 years after this for the S&P 500 and the real estate market just to get back to even. Now let's zoom out. Well, after 2000, after the dot-com bubble busted, it took 7 years to get back to even. And then we went through the great financial crisis and it took 6 years. It took 13 years basically to go nowhere. Now, if you look here at the NASDAQ and the tech stocks, it actually took 2 years longer and took 15 years. Now, I don't know about you, but if you're under 15 years until retirement, I don't want to sit there and have my money just basically go up and down and go nowhere. You've got to have a strategy, and buying and holding is not a strategy that you're going to want to be invested in. And here's why. It's the math of percentages. The larger the loss gets, the higher the return just to get back to break even. So if I went down 10%, I needed 11% just to get back to even. What about 20%? I need a 25% return to get back to even. 40 jumps up to 67. 50, like we just saw in the last two slides, I need 100% return just to get back to break even. So you've got to avoid the weakness and the major drawdowns in this market. But Jim, I'm diversified. I own bonds to protect my portfolio. Well, not so fast. The S&P 500 is down 19% through June 30th of this year, while the aggregate bonds, which is the S&P 500 for bonds, is down almost 11%. A 60-40 kind of bond equity mix is down 16% through June 30th. So these are two areas of weakness that we see and have seen, and we're in protect mode, not only on the equity side, but also on the bond side. So diversification did not help you this year. But Jim, there's what about market timing? I actually know there's actually a couple large firms here in the Dallas-Fort Worth area that use something very similar to this, that they, if it's above this market average, we are in, and if it's below, we are out. Well, as you can see here, here's where they got out, got back in, got back out, got back in, got back out. They may talk about being in cash, but they've gotten whipsawed tremendously this year, and their performance is roughly down about 18% year to date. They would have been better off just being in a static 50-50 than trying to guess what this market is doing. But if you focus in a little bit over here where we are today, it's going to have to go up about 15% before they even get back into this market. So not only are they down 18%, but they don't tell you that it's going to take a long time before they get back into this market. Again, market timing does not work. So what does work in a bear market? I'm going to show you.
So what does work in a bear market? It's two things. It is seeking strength and avoiding weakness, and I'm going to show you in real life. Friendships. The old saying is, you are who you surround yourself with. So if I surround myself with strong, successful, powerful people, I'm also going to have those traits. If I surround myself with weak complainers and whiners, I'm also going to have those traits. So which one do I want? Do I want to have that strength, or do I want to have that weakness? Business. You're a business owner. You have to hire or fire somebody. Do you want to hire someone that's dependable, who gets the job done, shows up on time? Or do I want to hire somebody who's always constantly late, calling in sick, and not getting the job done? You know the answer there. Sports. I'm a coach. I'm constantly seeking the best 5 or 6 kids to put on the court every single point, every single play, to give me the best chance to win the game. Okay, everyone else is on the bench. They're my weakness for right now. So why don't we do that for investments? Why are we in emerging markets over the last couple years when they're underperforming? They're very weak. Why are you in international over the last 5 years when they've underperformed the US market? Okay, I don't want to have them in my portfolio if they're not doing anything for me, if they don't show those signs of strength. So the key is avoid bear markets in your life, period. And that includes on the investment side. So let's take a look at the first half of 2022. On the equity side, we went to protect mode early. We were seeking safety, and hard assets were the strength. The commodities, the gold, the oil, etc., were the first half strongest asset classes, and we avoided a lot of equities, including tech. On the fixed income side, it told us to seek ultra short bonds, avoid high yield and long-term bonds. Okay? Here's some other areas. Here's some stocks that I know you've heard of. This were extreme areas of weakness. Meta or Facebook and Disney were down over 50%. they've got to double in price based on the graph that we saw earlier just to get back to zero. Netflix and Zoom down 75 and 80 have to go up 400 and 500% just to get back to zero. So what do we want to do? We want to eliminate this weakness in our portfolios. I can always buy them back, okay? Or if they're a taxable account, take the tax loss, okay, to offset future gains that you're going to have, but eliminate those out of your portfolio. That's it. Thank you for joining us. Our next update will be Monday, July 18th. So thank you very much. We look forward to seeing you then. Have a great week.